Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, you're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a very, very quiet backdrop as far as Wall Street is concerned. It did not look like it would be a very quiet and quite close, actually, I should point out, when we were closing here at 3:30 yesterday. But that is what we have in terms of a handover. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleague Surabhi and Nigel. Guys, hi, morning.
Hi, morning, folks. While we're focusing on the market, I'm also focusing on the clouds. So I'm wearing colors of the season because it's sort of, blow hot, blow cold kind of weather in Mumbai as well, right? With some rain here and there.
Well, that's right, and it's May 20th, so we're getting to the fag end of earnings. The countdown, last 11 days, I think so.
Yeah.
And then we'll be done and dusted. So, bright times, I think. So, global markets pretty okay. GIFT Nifty suggesting an uptick. So, Surabhi is happy with the rain. And towards the end of earnings season, which hasn't been that bad, I think so.
But I think the weather, guys, it's like a...
It's all over the place.
It's a sauna.
Yeah, it's a furnace.
It's a sauna. It's a, just...
It teases you with the clouds. And then you realize the temperature doesn't match up with the look.
For those of us who work inside in air-conditioned offices, it's great. But people who've got to be outside,
It's really tough.
Difficult.
It's a tough one. Well, let's just quickly run you through what you need to know as you begin this new session. You basically have the S&P now, which is on a 6-day winning streak. This is after last night's almost unchanged close. I mean, nothing at all on the S&P. So it's there. You can see it, 0.09. But the important thing is that you had a 1% drop at the open, which was fully recovered right there. It didn't... there are some data points indicating that retail buyers in the US, just like retail here, they were big buyers of stocks into that 1.5% drop at the open that we saw. 10-year yield was down about 3 basis points to 4.45%. But from yesterday, Asia, that means that from the highs on yields on the 10-year, we got a 12 basis point swing from Asia high. So finally at about 4.45. You also had the dollar index, which is about 100.44. So, it looked like yesterday evening, 6 p.m. our time, when you looked at how Europe was trading, how US futures, etc. were trading, that are we going to get one more of those episodes of, US assets being sold? But it did not turn out that way, and some of those dips were bought. Is the concern all done and over with? Absolutely not. And I think we'll need to watch this space closely. Oil prices were flat, $65.50 is where oil left off. Lots of Fed officials spoke, by the way, and they all kind of expressed concern about inflation, saying that they need data over the next couple of months to make any determination. This is the thing. If you think about it, April 2nd were supposed to be reciprocal tariffs. Any data before that, we had to discard because of things like front-loading, etc. People would stock up in anticipation of the April 2nd tariffs. Then April 9th, you got the pause. So any data after that you had to disregard because, how do you make sense of it? Will exporters push out more? Will importers hold on? Now you got the US-China sort of pause as well. So data pretty much has been, tarred by all these, start, stop as far as tariffs are concerned. And that is the reason why some, especially, people like Williams, Bostic, etc., who spoke, they said that we'll need at least 3 to 6 months to assess the impact of tariffs. But the message is clear. They are worried about inflation. It's just not clear whether they should trust the data which is coming out now to make that determination. Now, President Trump, he said he spoke with Russian President Putin, and he shared an update on Truth Social, almost call minutes with Putin. He said that ceasefire negotiations with Russia-Ukraine would begin immediately. He said Russia wants to do, in his typical style, large-scale trade with the US when this catastrophic bloodbath is over. So that was the post, as the specific line there. So we'll see how this goes. But, it's good news in terms of really the casualties which we see on a daily basis in that war. But a final deal, let's see what really comes our way. Just to tie in the levels here then, the Nifty support stands at the 40-hourly exponential moving average, which is now moved to about 24,811, not very far from where we are yesterday. On the upside, we need to take out the 78.6% retracement of the entire fall, which stands at 25,310. So we'll see if the market's in a mood to make a push. Nifty Bank, it attempted to break out above the 55,500, but did not close above it. We left off at 55,420. Support here is the 40-hourly exponential, which is 55,131. And here we need to take out 56,098 for, a broader up move to begin once again. So in a bit of a no man's land, I would say. And we just still need to be a bit on watch as far as the US bond markets are concerned, if you are worried about anything hitting us from a global market perspective. GIFT Nifty, I think it's indicating a 100-point higher start. We'll see if it sticks and if you're able to build on it. Surabhi.
It's looking good, actually, across Asia, and that's what the implied open is also indicating, that the bulls will perhaps start their charge again today. And most of the markets are building on the fact that Wall Street managed to eke out a little bit of a gain even yesterday. So if I'm looking at whether it's the Japanese market up about 0.5%, or the Hang Seng, which is up about almost 1% right now, Taiwan, most of the markets, Singapore, everything's up and about. By the way, in Hong Kong, today the world's largest battery maker has listed. CATL, as the company's, the abbreviation goes, and it's been a good listing, 14%. It's the largest listing this year in the world. Company has managed to raise $4.6 billion. So that's, adding to the sense of excitement in Hong Kong today. Anyway, there's a fair amount of data to go over as well. First and foremost, the news came in on the rate cuts in China. This is the first time in 7 months that the PBOC has moved on rates on the 1 and the 5-year loan prime rate. The reduction is 10 basis points on each of these. So the 1-year LPR now stands at 1.4%. The 5-year loan prime rate stands at 3.5%. By the way, Chinese-backed, state-backed banks, they've already started cutting deposit rates by a greater measure. Almost 25 basis points rate cuts announced already by several banks which are backed by the Chinese government. On China-US trade, it's usually blow hot, blow cold. And yesterday, late evening, post our market close, China came out accusing US of trying to sort of unsettle the Geneva Accord, or the agreement or the understanding that was arrived at in Geneva. Now, China is accusing US of undermining the preliminary trade discussions because of the US warning against use of Chinese chips, semiconductor chips. In particular, the US has singled out chips that are made by Huawei. And China is not taking too kindly to it. So there was a statement by the Chinese government spokesperson saying that if the US insists on its own way and continues to substantially damage China's interests, then China will take resolute measures to safeguard its legitimate rights, and so on and so forth. So there's a bit of a skirmish there, verbal skirmish that's been going on. Let's see how it goes. For us, it's been a consolidation last couple of days. Friday and Monday, the market hasn't done too much, but individual stocks, there's lots of action. Let's see how that plays out. On the flows front, things are a little quiet as well. There was a sell figure of about 525 crores by the FPIs yesterday. Domestic institutions also on the sell side sold off stocks about 238 odd crores. So little quiet in terms of the net flows picture in the cash market. I'll keep watching out for defense stocks. Yesterday again was consolidation in the defense space, but the numbers have been looking good. BEL's numbers, watch out for this. Revenue up about 7%, and the margin has improved from 26.7% to almost 31%. So let's see. This space continues to be in focus as well. Nigel, how are you looking at things?
Well, yesterday the institutional data was something that was a little bit surprising because both of them turned sellers. But there's one point out there. If you look at their gross participation yesterday and you compare it with an average for May, actually both the FI as well as the DI participation was relatively lower if you compare it with the averages earlier. So close to around 16 to around 20% lower is what their participation was yesterday. So I won't read too much into the institutional sell number yesterday. What about the positioning? Well, on index futures, both of them are on opposite ends, not very, very aggressively. Though, in fact, the FIs are net short with close to around 23,000 contracts on the short side. The clients net long with close to around 10,000 contracts. However, the FIs on stock futures, they went ahead. They added some short positions and they unwound some long positions, which is telling you there was a swing factor there of around 60,000 contracts towards the short side. Not so bad. Well, moving to the options data then. The PCR, I made this point just last week that it had moved to around 1.3. And at that point of time, it was calling for some kind of cooling off because the upper end of the band has been around 1.5. Now, the PCR has come down to around 0.8. That's actually good, and that's a positive actually, because the lower end of the range is around 0.65 to around 0.7. And just take a look at the options data. You know, the 25,000 call, that's added a good amount of open interest, around 50 lakh shares. The premium over there is around 125 rupees, which is giving you the crucial resistance mark. So on the upside, you want this 25,150, 25,200 odd, you know, to get taken out. If you look at the resistance level, just plugging in that premium of them, this is the crucial mark that, you know, the bears will want to defend. So the bulls need to get past this and then, in fact, drive on from there. However, support levels you're looking at, the previous resistance becomes a support level. Even if you look at the options data, it comes in the vicinity of around 24,800. On the Nifty Bank, there are crucial levels that you're looking at. One is the 20 DMA. That comes in at around the 55,000 odd mark. However, last week's reference point is around that 54,500. And the point I've been making for the last many weeks is that the Nifty Bank needs to get past this 56,000 mark. That's what starts the fresh move in terms of an uplet. However, for today, I'm going to be looking at the metal index. And the reason is the Chinese, again, they're cutting rates. They're trying to push up that economy. So normally you have a positive rub-off on metal stocks. So that's why the index that I'm looking at for today will be the metal index.
All right, Nigel, thanks very much for that. So keep an eye out on the metal space as we begin this session. Matt Orton is with us, Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here. Prashant this side. You know, the question that, you know, actually I put out yesterday morning is that have we seen the peak as far as tariff good news goes? And if anything from here, we should expect you know, all the handshake deals have happened, not all, but at least the ones that, the big one has happened. But now you've got to work through the details, etc. Surabhi was just telling us some war of words with regards to chip, etc. So will, you know, this deteriorate, I mean, you know, it's all relative in markets, right? Incrementally, is it positive or negative? Have you seen the peak in terms of good news on tariffs, in your opinion, Matt? What's your sense?
Hey, Prashant. Good morning. It's always great to join. And I think it's hard to say whether we've seen the peak with respect to good news because there's still a lot that we don't know. There's still a lot of potentially good news to come. I think it's all about the margin. Have we seen, are we going to start to decelerate from kind of the acceleration of good news while it might still be increasing? The slope of that increase might start to change or flatten. And I think that's what we're starting to approach right now, is that acceleration is slowing. And it makes sense. There's been a ton of really positive price action baked into global equity markets over the past 2-3 weeks, and we need to cool down. And what I tell investors is that while I'm still biased to the upside, I still think that there's a lot of negative sentiment that's being reflected in market prices. Positioning is still largely neutral. As volatility continues to come in, a lot of the algorithmic flows are going to continue to support the market, especially if we have a leg lower. That all provides some fuel for further upside, but a little bit of a pause in some of that good news might be healthy for the market to reset, consolidate, and start to build another base upon which we can continue to rally to new all-time highs.
Right. Man, just one thing. This is a bit of here and now, and I'm just taking a shot at it. Lots of tweets and social media posts, and some of them are quoting JP Morgan. I don't know if you've seen this. This is last night's 1% reversal at open. Apparently, JP Morgan is saying that retail traders bought some $4 billion worth of US stocks at open, making the largest intraday retail inflow on record. That is last night. Anything special happened last night? I mean, have you seen this?
Yeah, so when you look at the flows, retail investors have been supporting this market for a long time. Retail investors were buyers as the market was going down, even on Liberation Day, and retail investors have continued to be buyers of the market even as we've continued to make new highs. So it's not surprising to me to see these sort of strong flows. And I think it comes on the back of good news from the Middle East, more investments that are being made. And I think all of that just comes together and creates large buy orders. So I don't know if anything very special happened, except that it's been a trend for a while. And I don't expect that to abate, which is another reason why I still find it hard to be too negative on where this market ultimately goes.
And the market's been going only up, hasn't it, Matt? Hi, great to have you on the show this morning. Thanks for joining in. So, whether it's the US market or whether it's the India market, we're just 4 or maybe 5% away from the all-time high levels. So let's talk India. now that you've seen a lot of the earnings here as well, do you think the market has the juice to keep going higher? And what would you buy? I mean, we know that you like the big banks here like ICICI, but what else looks interesting to you at this point?
Hey, Surabhi, that's a great question because I've been looking at a lot of extension themes. So the Indian market, as you know, is my largest overweight outside of the US, and that remains the case right now. Financials, banks, still an area that I like a lot. I'm encouraged by the numbers that we've had, but earnings season has been positive. It's helped support the market from that detox period we had, the painful detox period, with the 15% plus drawdown. But as I look at what's working across global markets, I think one of the things I like to lean into are long-term, durable, secular growth themes that are playing out around the world. Some of that's artificial intelligence. Some of that's with respect to a strengthening, growing consumer class, and that's particularly relevant to India. So Interglobe's been a favorite holding of mine. So looking at extensions to that, Make My Trip, that's an interesting holding as well, because you're looking at companies that are able to tap into consumer demand for travel and do so in a way that's levered towards technology to bring down overall prices. So that's one interesting name I'm looking at. Paytm 197 Communications, another name that I think looks very interesting just from a financial services fintech extension of the consumer continuing to expand. Geofinancial is another name. Strong artificial intelligence backbone. A company, while it's expensive, Paytm's expensive as well. I think the market's willing to support those valuations if you deliver growth. And both of those names so far are delivering growth.
Yeah, that's very interesting. So I'm just recapping. Since you like the global AI theme, you're looking at names like Paytm and Geofinancial as an India extension. And there's Interglobe and Make My Trip. Wonder why they didn't list Make My Trip here in India. I mean, we could have had a slice of the action, but then it's only for the global investors for now. Nigel.
All right, Matt, final question before we let you go. The Indian markets, I think that's been the top pick for you, the top market that you're betting on. But in the last couple of weeks, suddenly the United States and China, they managed to eke out a deal. And now you have the Chinese that are trying to pep up their economy. They're cutting rates, they're trying to push in some liquidity as well. They have valuation support, but would you still back the Indian markets over the other emerging markets like China?
Yeah, Nigel, that's a great question. So while India is the largest overweight, I have been looking for other ways to diversify my portfolio because diversification has been a key theme I've been pressing to clients and that I've been trying to invest in. And so outside of India, we know the weaker dollar has helped be supportive as we see global growth kind of come back to life. Commodities are working a little bit better. So Latin America has actually been a very interesting place, especially given some of the pivots we've seen with respect to trade. Countries like Brazil are very, very interesting to me and I think are attractively valued relative to the rest of the world. I think China is a little bit of a red herring. While you're seeing support from the government with respect to interest rates, I actually think the trade deal makes the government in a position where it can't provide the bazooka that they really need to jumpstart what I think is a deflationary spiral. It's just really hard for me to get excited about China outside of anything but being a trade, a shorter term investment vehicle, because the government's not willing to do what it needs to do to actually get the consumer going. Contrast that to India, that's not at all the case. You have a burgeoning consumer, incredibly strong support between the public and the private sector, and that's a recipe for long-term success. So India is an own, China is a trade.
Okay, all right. Thanks very much, Matt. We lots more questions, but it's the earnings season. Thankfully, we are wrapping the earnings season out, and longer interactions. Look forward to them from here on. Thank you for joining us as always. Let me just quickly run you through the interactions which are lined up here over the next 2 hours or so. So you'll hear from the management of QuestCop at 8:35. Fourth quarter numbers, but also the outlook ahead. 9 o'clock, New India Assurance will talk about their fourth quarter earnings. Pankaj Murarka will be with us to talk markets and stocks at 9:15. 9:30, IRB Infrastructure to decode their earnings. Hyundai Motor India will be speaking with us at 9:40 after they posted earnings. And Kulin Lalbhai of Arvind Fashions talks to us at 9:50 for their earnings as well. Towards the end of the program, it's our segment, Indianomics. Latha in conversation with three top economists to discuss what to expect from the GDP numbers. Stay tuned.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you. We'll get to that in just a bit. For the time being, I'm running you through our top 10 list. BEL, PI Industries, DLF, IRB Infra, NLC India. They'll be reacting to positive news flow. Add to the list Petronet LNG, Readington, and Aeros Life Sciences. However, two stocks will be reacting to negative news flow: Power Grid and Gujarat Gas. Take that break, come back. We get into further detail on all of these names.
Welcome back. It's a green morning across Asia, and markets, depending on which one you're looking at, could be up between 0.25% to as much as 1%. And the Hang Seng is running away 1% higher over there. But the Japanese market's not too bad, 0.5% up. And mainland China also chipping in with some gains. So the implied open is telling us that the bulls will be back to their winning ways, at least at the start, expecting almost a 100-point pop. There you go, perfect 100 at the open. Now, what about individual stocks? Lots and lots of earnings to go over. So let's straight away get to the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Ria, let's start with what else? BEL. Very high expectations from all these defense companies. Has BEL delivered?
Well, yes, good morning. BEL has reported a good set of numbers yesterday. The net profit has been above our expectations of around 1,800 crores, coming in at about 2,127 crores. Even on the margin front, they've outperformed, coming in at 30.8% versus our estimates of 25.6%. For the full year FY25 as well, revenue has surpassed the company's guidance of 15% year-on-year growth, coming in at rupees 23,769 crores, which is a growth of around 17.3% on a year-on-year basis. Even the EBITDA margins have come in at 29% versus 25% in FY24, up around 400 basis points, and again surpassing the company's guidance of 23 to 25%. The order book position of the company right now is at 71,650 crores, which is about a 5.5% decline over the previous year. Even on the order inflows front, the company has underperformed. They had reported this in their provisional update as well. The order inflows have come in at rupees 18,715 crores versus the guidance of 25,000 crores, so they've fallen short on the guidance on this front. And the order inflows are also down around 45% on a year-on-year basis versus FY24. But since they've outperformed on the revenue and the EBITDA margin front, we're going with the green for BEL.
Thanks a lot for that, Ria. Well, let's hop across and get in. Vivek is here to tell us about the other big name, which is Power Grid. Morning, Vivek.
Well, good morning. Power Grid, largely in line to slightly muted set of numbers when you're looking only at the P&L as far as Q4 FY25 is concerned. Revenues higher by 2.5%, EBITDA higher by 1.5%, and when you're talking about the margins down 100 basis points on a year-on-year basis. Profitability down 0.6% on a year-on-year basis. That was a miss versus our poll. But what we will be looking at, especially FY25, will be two numbers. Number one is the capex and number two is the commissioning. So the consolidated capex has been stronger than what the company had given at the end of Q3. They had given a guidance of 23,000 crore. The number we understand has come in at a little over 24,000 crore. So that is a positive. However, when you're talking about the capitalization, that has been weaker. We understand that it has come in the range of 8,700 to 9,000 crore versus a guidance of almost 18,000 crore. So that will be the key question investors as well as analysts will ask in the call today, given the fact that what has led to the delays as far as the commissioning is concerned. Overall, when you're talking about two important developments, the company said that they will exit two JVs, one JV with Torrent Power, the other JV with Sikkim Power. So overall, expect some pressure on the stock today, at least till clarity emerges as far as the delay in commissioning is concerned.
Okay, all right, Vivek, thank you very much for that. But IRB Infra is on your radar, and of course, we'll speak with the management later. NLC India as well. Take us through those.
Well, that's right. So IRB Infra, when you're looking at the P&L, slightly subdued, but toll revenues as far as FY25 is concerned has been quite strong. So revenues higher by 4.3% on a year-on-year basis, EBITDA higher by 12.2%, EBITDA margins expanding almost a little over 200 basis points, and profitability higher by 13.5%. Now, when you're talking about the BOT as well as the TOT revenues, it has come in higher on a year-on-year basis. And when you're looking at the order book is quite strong. The order book is in excess of 30,500 crore. But what is it that the street won't like? The street will not like that the EPC portion of the order book has actually gone down quite drastically. And this is something that we will need to ask the management, what is it that has led to such a significant shortfall? It appears as though tendering activity has not been very robust as far as FY25 is concerned. FY26, we will need to look at the bid pipeline as well as the tendering activity. Now, talking about NLC India, a lot of one-offs, especially given the fact that this is a regulated entity, but overall a good year as well as a good quarter. Revenues higher by 8.5%, EBITDA higher by 43%. But remember, as far as EBITDA is concerned, employee expenses this time around was significantly higher, depreciation higher as well, and other income this time around was quite muted. So profitability, there was significant one-off items, is up almost 4.2 times on a year-on-year basis. But remember, there are multiple one-off items as far as the P&L is concerned. Segmental revenues, mining revenue is down 8.3%, but power generation revenues is up 9.5%. Expect both of these stocks to end the green today, but IRB Infra quite a few questions to ask the management later on.
And we'll definitely do that, Vivek. Don't you worry. Now that you've told us all the numbers, we will have Mr. Anil Yadav from IRB Infra joining in to talk about the company's performance and the outlook. All right, let's move on to some numbers coming in from the oil and gas space. Petronet LNG as well as Gujarat Gas. Sud is here with us. Morning, Sud. How do they look?
Morning, Surabhi. So for Petronet LNG, despite the adjustments, earnings are looking largely better than estimates. Revenue has increased by 1%. Reported EBITDA was up 45%. If you adjust impairment gain, it was up 7%. Reported margin has come in almost 400 basis points higher at 12.3%. Adjusted margin was at 10.4% versus 9.8%. CLSA, though, maintains underperform call and target is pitched to around 70 per share. It says core performance was a smaller beat to expectations, but volumes were 8% miss. Earnings call is at 11 a.m. We'll wait for more details. For Gujarat Gas, I'm going with red. Earnings were largely in line, but industrial segment, which forms more than 50% of total volumes, have seen a decline of almost 21%, while CNG volumes were up almost 4% on a sequential basis. Talking about headline numbers here, revenue was down 1%, EBITDA has increased by 18%, and margin was at 11% versus 9.2%. Nomura maintains reduced call and target is rupees 470 per share, and CLSA maintains underperform call and target here is 385 per share.
Okay, all right. Thanks a lot for that, sir. Well, going back to Ria, she's here to tell us about DLF as well as PI Industries numbers. Ria?
Well, yes, both PI Industries and DLF have reported quite a good set of numbers yesterday. First up, for DLF, the bookings in Q4 have grown by around 39% on a year-on-year basis. Even collections are up by around 51%, coming in at rupees 3,320 crores. For the full year FY25 as well, the bookings value is now at rupees 21,223 crores, up around 44% over the previous year. And this is versus the company's guidance of rupees 17,000 crores, but they had surpassed this in Q3 itself. Collections have also jumped up by around 36% over the previous year. Launches for FY25 were around rupees 40,600 crores versus their launch pipeline of about rupees 36,000 crores. Going ahead in the medium term, they have a launch pipeline of about rupees 73,900 crores. Moving on to PI Industries, we've seen the net profit going down by around 10.5% for Q4, but the revenue and EBITDA have gone up by around 3% each. In the agrichem exports business, we've seen a 5% decline overall, but the volume has gone up by around 7%. The domestic branded revenue, for that has grown by around 21% on a year-on-year basis, and the volumes have also gone up by around 24%. The FY25 gross margin has also improved to 53% due to a better product mix in this year. Going ahead, they've said that the global biologics revenue is expected to grow around 5 times over the next 5 years, and in the pharma CRDMO business as well, they're expecting to achieve over 75% revenue growth in FY26 itself with improved margins. So going with green for both of these stocks.
Thanks very much, Ria, for that. Well, let's talk about Readington and Aeros Life. Vinny's got details on both. Vinny, morning.
Good morning. Starting with Readington, decent set of numbers that's come in from the company. Muted growth sequentially, but on a year-on-year basis, the company has managed to see an 18% growth. Margins have remained largely stable at around 2.3%. Whether you look at QOQ or YOY, it's around that mark. So yes, not a bad set of numbers coming in from the company. Margin stable, profit growth, sharp growth in terms of profit. That's why we're expecting a bit of a green for Readington. Moving on to Aeros Life Sciences, now largely in line set of numbers come from the company. Steady revenue growth. Margins have seen a growth of almost 36% sequentially as well as YOY. But what's interesting is the commentary for FY26. A very good commentary for FY26. The management has guided domestic business EBITDA margins at 37%. Export business EBITDA margins at around 35%. They're expecting 800 to 1,000 basis point EBITDA margin improvement also in the insulin business. So that is something in terms of the commentary which is positive, and that is why we could see green coming in for Aeros Life Sciences as well.
Okay, all right. Thanks a lot for that, Vinny. Well, let's do a quick recap of all the top stocks that we're looking at. The ones with positive news flow: BEL, PI Industries, DLF, IRB Infra, NLC India, Petronet LNG, Readington, and Aeros Life Sciences. While stocks with negative news flow include Power Grid as well as Gujarat Gas. Well, let's get a check on the commodity space. Manisha Gupta joins us to help us out with what's going on there. Morning, Manisha.
Morning, Nigel. I'll start with the crude oil prices, which are the only sector, by the way, which is trading on a firmer note. This is on the uncertainty of progress of U.S.-Iran nuclear negotiations. U.S. is demanding a complete halt to Iran uranium enrichment, which is not happening, and that is what is leading to some support coming in for the crude oil prices. But apart from that, almost everything else is trading slightly on the weaker side. I'll start with gold. It did gain 1% overnight after Moody's downgrading U.S. credit rating and U.S. Treasuries shooting up. But at this point in time, it is all about the U.S. president's statement talking about the Russia-Ukraine being on path to ceasefire. Well, that has led to the safe haven premium going out. You have the gold prices trading 0.5% down. Silver is trading in the negative as well. And then apart from that, when you look at the Chinese data, well, we did see those numbers coming on the weaker side as well. The industrial production and retail sales, fixed income investment, all of that has been on the weaker side in China. That's weighing on copper. Aluminum fell 1% overnight. So barring crude, all precious metals, base metals trading in the negative in Asia.
All right, Manisha, thank you very much for that. What we'll do is we'll take a quick commercial break here. We're going to come back with the management of QuestCop. That's a staffing company. We discuss their fourth quarter numbers and the outlook going forward. Stay tuned.
Welcome back. Let's get going with our corporate interactions on the show today. First up, we have QuestCop. The company reported a slightly weak performance in the fourth quarter. There was a decline in revenue sequentially, and there was a loss due to an exceptional expense. Remember, Quest has been going through a demerger as well. So let's discuss the company's performance and, more importantly, the outlook for this year. We have Guru Prasad Srinivasan, ED and CEO at the company, and Sushant Pai, the Chief Financial Officer at QuestCop. Gentlemen, morning. Thank you very much for joining in. Mr. Srinivasan, if I could sort of come to you first, just give us a sense. I mean, I know that there are those exceptional items in the expense of the demerger, which is impacting the P&L. But if I start with just looking at even the quarter-on-quarter comparison, there is that slight decline in the revenue. Just tell us how your business is, staffing, general staffing, professional staffing, and overseas. What are you expecting for them as this year unfolds?
Sure. Thank you so much for having us. And, we are happy to announce our first independent result for QuestCop post-demerger. So on annualized basis, our revenue is up by 9% and our EBITDA is up by 12%. And our adjusted PAT is up by 54%. And specifically when it comes to debt, and we have been guiding that, we'll be almost a debt-free company, and our gross debt is at 12 crore and our net cash position is about 255 crores. So I think we have successfully completed our demerger process, and this is the first result that we have declared. Coming specific to between the quarter, of course, headwinds in specifically segment, specifically for BFSI segment. So we had a decline in headcount from one of the specific NBFC customer. But otherwise, overall on year, if you look at both our professional staffing and general staffing, has delivered about 11% growth on the revenue. And for FY26, we still, at this size, we end our headcount at 459,000 at a group level, and we still anticipate to grow at, entry-level double-digit growth even in the coming year.
On BFSI and IT specifically, when we talk to obviously the IT firms themselves, there's still a fair amount of uncertainty in terms of how the business is shaping up. But, can you be a little more granular? You're saying that the slight sort of weakness was in these segments. So what is your anticipation? Is this a passing one-quarter phenomena, or could this last for the next couple of quarters?
Yes, this is a one-quarter phenomena for Q4. But specifically, if you look at our IT has delivered about 42% in terms of its EBITDA growth, and perhaps we have it's a fantastic year in terms of IT delivery for us. We have been ahead than our AOP plan for FY25, and we see the similar kind of trend because of GCC push and almost 70% of work that we are doing is in the GCC space. We still continue to see the demand. Our demand, even for Q1, has been almost about 1,300 open mandates that we are working on, all our high-end niche technology profiles. So while IT services are not active and hiring, but we are definitely seeing good set of mandates coming in, and it's also reflecting in our result. From that standpoint, overall, if you look at, we are still on both revenue and EBITDA, we are still confident to deliver a double-digit growth even in FY26.
Mr. Srinivasan, morning. Mr. Pai, morning.
Morning.
I remember, I think it was 2 quarters back, we had, I think, the team lease management, and we were having a similar conversation between traditional IT services compared to GCCs. And while GCCs, of course, have been growing very fast, I mean, the outlook they put out was very clear that it cannot replace IT services. Just the sheer numbers are just, still very, very different. So I just wanted to ask that question to you, Mr. Srinivasan. What is your sense? You're saying it's all led by GCC. 70% you're now, when we say IT, you're focusing on GCCs, isn't it?
That's right. You're right. And that's exactly what we are witnessing on our open mandate as well. As I said, 70% of our open mandate, unlike past, a year ago, more than 8 quarters ago, if you look at our IT services mandates were almost about 60%, and now that is replaced by GCC. So it wouldn't be wrong to say that GCCs are the captives are being set up, and it's working out well for customers in terms of the cost and the delivery structure and the control over the operations that they run in terms of the end-to-end operations. And a partner like us who are well set in terms of hiring the right talent, bringing them to the desk, working with us directly is much more beneficial for the GCCs, and it's much quicker, faster for them to take typically that 100 to 300 seaters.
And the pipeline is very strong. It remains strong for GCCs.
Yes.
I mean, let's say IT services hiring is flat for the next a couple of years.
Absolutely.
GCC will make up for that.
That's what we are witnessing for last 4 quarters, and even as I said for Q1, our mandate levels have not come down. We still have an open mandate of about 1,300 mandates. So we are still bullish about this year as well.
Okay. Let me come to Mr. Pai as well. So, Mr. Pai, we just heard Mr. Srinivasan say that this will be a year of double-digit growth. I think he said at the top line, right? If you could just expand on that. In terms of margins, what would you aim for this year? And again, is it is it going to be a slower start and then a pickup in the second half? Basically, what are you anticipating?
Sure. Good morning, everyone. First, I thought I'd just talk about the margin profile of our business, right? General staffing, 87% of our revenues actually bring 59% of our profits. And I want to concentrate on professional staffing, which is about 6% of our business, bringing 23% of our profits. So the margin profiles are very different. General staffing has about 1.5% margins. However, professional staffing has about 9% margins. And that has grown very well, 42% year-on-year growth on margins. So as we go forward, it's very clear, though we want to have revenue at double-digit growth, we are very clear that profitability will be on a very non-linear basis because we have done various interventions. We are concentrating on high-margin business for the future. Our operating cash flow conversion has been very good, as you have seen for the year. On normalized basis, it's more than 75%. And we have a very healthy balance sheet. Our DSO is reduced by 7 days as compared to the last year. And we have about 255 crores of cash. So broadly, from that perspective, our focus is that our profitability will accelerate much faster than the revenue growth for the coming year.
All right, quick question, gentlemen, before we let you go. As you all have mentioned a couple of times, you're sitting on around 250 crores of cash and generating good amount of operating cash flows. How do you use it? Will there be some inorganic growth that you're looking at?
Not inorganic growth immediately because, Nigel, if you look at, we almost add about 80,000 people in a quarter, and it doesn't make sense to do any kind of acquisition in that space specifically when it comes to general staffing and anything in India. But of course, the board has, approved, the best way is to, when there is no acquisition, to return the cash to the shareholders. So we have in principle approval from the board to increase our dividend paying ability to 75%, up to 75%. And we would be a high dividend paying stock as we move forward. I would get Sushant to add anything further.
No, nothing from our side. As you can see, the board has approved a revised policy. So, it's a combination of dividend or buybacks or whatever capital allocation to shareholders. So that increase is there, and that's the way we will utilize cash as well.
All right. Shorter conversation today, gentlemen. Thank you both for joining us. It's a pleasure having you with us, and we'll speak again soon. I think we have Amnesh Agarwal now joining us to take us through what he's making of things. So yesterday was a very, very quiet day, although for the broader market, there was lots and lots of activity that we did actually indeed see. Thanks very much, Amnesh. Good to have you here. So that point about, I don't know if you heard the Quest management, the broader point to me was that the GCCs really are picking up the slack in a very large way. I mean, that's good, right? It's not just for Quest or a company like these staffing companies, but overall from a consumption point of view, etc. I mean, because IT services has been the big support factor for consumption in so many ways over the last 2 decades or so. And as IT services starts to slow, and especially according to some in a more meaningful kind of way, you have these captives which are hiring, and these are well-paying jobs.
Yeah, hi Prashant. You rightly said. You see, if you look at, say, not now, maybe last 2 to 3 years kind of a trend, IT services has not been doing that great. If you look at, say, the companies, some of the companies have even, say, fired some employees because there was a lot of, you can say, excess hiring or reckless hiring, which also happened post-COVID. But particularly, I think in the last 3-4 years, there has been a lot of momentum which has come into these, all your global capability center or GCC, which we call. And I think today, I think they are giving employment much more than some of these IT services companies are giving. And that is actually driving the entire your services exports and keeping things well for a country like India.
Okay, all right, got that. Amnesh, let's talk about a lot of the companies that have come out with numbers over the last 24 hours or so. Starting with BEL, I mean, we've discussed the defense theme for the better part of the last 1 week. Now, the numbers for BEL are also looking good, no doubt. Their margins have expanded, so looking good. But the question is all of this already captured by the stock price? What's your thought?
Yeah, if you look at last, say, particularly 15-20 days, okay, there's a tremendous amount of momentum which has come into all the defense stocks. Now, BL, as I said earlier, also it has got some advantage that it caters to, you can say, requirements of all the 3 forces, that is your Army, Navy, and Air Force. And in fact, if you would have looked at the discussions that the radars and other systems and electronic systems which were created by BEL, they played a very vital role in the recent war, or a short war which we had with one of our neighbors. Now, I think as far as the order book is concerned, I think it remains on a very, very solid ground. There's absolutely no doubt that even you look at, say, 3-year, 5-year kind of a view, and the kind of incidents which have happened recently, and if India has to prepare for, say, a 2-front or a 3-front war in future, then we will need much more arms, much more armaments, radars, and all these things, and the order books are going to remain healthy. And I believe that going by the margins of 4Q, which are about 30%, there's a reasonable amount of some earnings upgrade also happening. However, given the fact that the stock has jumped by nearly, say, 40 to 50%, from the lows in the last couple of months, I think the incremental returns will come at a more moderate to measured pace.
Hi, Amnesh. Thanks a lot for joining in. Amnesh, what about PI Industries? What's the view there? It's been a big value creator, over the longer duration. But if I look at their guidance, they're looking at single-digit, revenue growth and margins remaining stable. Though the smaller part of their business, the pharma business, they're talking about 70-75% growth out there. Your view on the stock?
Nigel, if you look at the entire agrochemicals space over the last couple of years, the space has not been doing that well. Whether you look at the companies which are more domestic oriented, or whether some of the companies like PI which get a fair share of their from even say abroad. Due to, and it has been happening due to whether it is, you can say the global warming led weather variations, whether it is due to lot of changes which are happening as far as your demand supply is concerned and your chemical prices globally. So I think the guidance doesn't seem to be very encouraging for most of the companies in the sector. And this sector, eventually in the longer term, it can't grow very fast because your land mass or the areable land that doesn't grow every year. The land mass practically remains the same. Now, I think in the longer term, yes, if you look at say last 5, 7, 10 year kind of a view, then PI industry has really done well. But having said that, in the near term, it seems that not only for PI, but for many of these agrochem companies, the growth has peaked out. So in that context, I think the returns from here will come only at a very measured pace. Yes, pharma is there, pharma can grow, you can say faster, but the contribution to the overall pie will be very limited. So I think at this point of time, in the longer term, one can hold on, but with very, I would say, moderate expectations.
Okay. We'll take a break. There are two other stocks from yesterday we want to address. One is delivery. Lots of upgrades. Stock was up 10% yesterday. The other is Protean, which of course was down sharply after news flow. So, Amnesh, we'll come back to you on those and more. Take a quick commercial break here. Sudarshan and we'll have Chandan Taparia with us today to run us through some trading ideas. Stay tuned.
Welcome back. Hope you're having a good morning. As promised, we have our technical experts with us, Sudarshan Sukhani and Chandan Taparia. Good morning, gentlemen. Thanks a lot for joining in. Well, Sudarshan, I think yesterday the call was don't rush in to buy. I think you were calling for some consolidation after being positive for the last few trading sessions. Today, what's the call? We'd like to start off 100 points up, which means we erase any kind of losses that we saw yesterday. What's your take?
Yeah, good morning. See, we had 2 days of consolidation. Entering inside a consolidation is usually difficult because then you get chopped around. Now I should sell, now I should buy, and that's a problem. But today is a different day. After the consolidation, the markets should normally resume their existing trend. The existing trend is up. So despite the fact that we are having a 100-point gap up, I would suggest that we should now follow the market trend. The gap actually says that the market trend is resuming itself. Consider buying the bank nifty first and then the nifty. Both could be bought in 2 stages. One at the open after the markets just stabilize at that point. And second, if there is an intraday dip. But today, the trade is very clear. Go long in both the indices.
Gentlemen, morning. Chandan, what about you? What would your recommendation be?
Good morning, Prashant. Thanks for having me. So Nifty has seen a consolidative move, but major trend is positive as it has been making higher tops, higher bottom, and key levels are being respected in the market. So I'll continue to be with buy on decline stance with the view that 24,750 could act as a major support. One can buy on any small decline for an upside target towards 25,200 to 25,400. Looking at Bank Nifty index, it has been consolidating in a range, but technically it is at words of giving a fresh breakout from its pole and flag pattern, which has bullish implication. So it requires a small follow. And I believe with support of 55,000, Bank Nifty has potential to rally towards 56,000 to 56,500 zone.
Okay, so there's a Poland flag, which indicates there's a bullish breakout perhaps coming. Got that, Chandan? On the indices, both of you gentlemen are positive. Let's also talk about individual stocks. Sudarshan, what would you go with today?
Well, it's again an all buy list for mid caps. Astral is a buy, the stop under 1397. Phoenix is a buying opportunity, stop under 1572. Torrent Pharma is a buy, the stop under 3234. And Paytm is a buying opportunity. Keep this very short term, will stop under 848.
Okay, all right, an all buy list from Sudarshan. Chandan, coming to you, what are your stocks today?
Yeah, so I think almost most of the stocks are repetitive, but again, conviction is there. So I'll continue to be with first buy on Astral. Technically, the stock has completed its triple bottom formation on the daily and the weekly chart and surpasses 50-day exponential moving average. We have seen surge in the trading volume with open interest activity. Delivery volume is also rising, and stock has taken key support at the lowest zone of 2022. So I believe risk reward ratio favors with positive price pattern. Because of that, short covering trigger also cannot be ruled out. So one can buy with support of 1390 for an upside target towards 1480 level. Second trading area, there is buy on the LODA. Real estate counter started to witness buying interest, and now the focus will be on upcoming RBI policy. And LODA has given a decisive breakout above key hurdle of 1390, 1395 zone and has been making higher highs, higher lows. In fact, on the weekly and the daily chart, the stock is at verge of fresh bullish breakout. So recommending to buy with support of 1400 for an upside target towards 1485. Last trading area, there is buy on Paytm. The stock is at verge of the classical breakout from its triangle formation. So a symmetrical triangle with support of key moving averages and the trend line is being formed. In fact, on the weekly chart, we are witnessing a narrow range price pattern, which clearly indicates a fresh leg of rally. So one can buy Paytm with support of 853 and stock can head towards 905 marks.
Okay, well, thanks very much, Chandan. Interesting ideas, interesting picks. Sudarshan, likewise, thanks very much, both of you, for joining us. And we'll, of course, have you back at 9:10 with additional calls. We'll take a quick commercial break here. We're going to come back with the management of New India Assurance for their fourth quarter earnings. Stay tuned. Okay, 2 minutes to go for the pre-open session. Amnesh Agarwal is still with us. Amnesh, thanks for waiting. As I left off our conversation, delivery is what I wanted to sort of ask you about. It's has performed poorly since listing, but is starting to come off the lows. Fourth quarter numbers were very strong, and it looks like, at least the management seems to be telling analysts, etc., that it's the number of players which is whittling down. I mean, there aren't that many players left now, strong players at least to compete. Delivery, of course, is also a leader as far as costs are concerned, so it's well run in terms of operations, and maybe now starts to gain market share. Any thoughts at all here? Delivery?
Yeah, see, delivery in the intermittent phase actually faced difficulty because many of the players who were on the e-com side and were using the services of delivery, say they went on some sort of a backward integration. However, I think there are 2 to 3 things happening. First of all, they recently acquired Ecom Express, the benefit of which will accrue to them because it leads to industry consolidation. The second part is that they are also now trying to get some sort of a pie in the entire quick commerce space, and they are in the process of setting up some dark stores, although the numbers so far is small. But that is something which is growing very fast, and I think that is where, as of now, it is loss-making, but that can turn around for them. And the third is a PTL business, which actually provided them a lot of momentum 3 years back, but somehow I think their margins there are on the lower side, which can actually come to the averages over the next 2 to 3 years. So I think there are many moving parts there. There are, you can say, several legs to growth over there, and it's a cash-rich company. So given that, I think now if the entire momentum on the e-com, quick commerce continues, and they continue to consolidate the business. I think in the longer term, it's a decent company. But yes, when it comes to any company which is into the e-com, quick commerce, or this kind of ecosystem, you can continue to have volatility quarter on quarter, or say maybe once or twice a quarter. So those kind of volatility will continue. But having said that, it's a formidable player, and given the fact that the industry has growth, in the longer term, it holds promise.
Got that. Amnesh, thank you for that. I wanted to ask about Protean as well, maybe next time. Appreciate you joining us, Amnesh, here on the program. I just want to look at, since the pre-open has started, I know it's early and maybe the initial rates are a little all over the place, but Protean was a big loser yesterday, and we should have that up on the screen to do a quick check. I mean, again, this is, the Nifty itself is showing a 0.75% cut, so I think we should wait maybe 3-4 minutes. But that was the big casualty yesterday. We have our next management ready, though. Insurer, Nigel.
Well, that's right. Let's get straight to conversation with Girija Subramanian, the chairman and MD at New India Assurance, who joins us on the show. Hi, thanks a lot for joining in. Well, before we get to the numbers, I wanted to compliment your team because personally, madam, I'd reached out to a couple of times to your staff and they've been very, very helpful. So on a personal note, quite satisfied with the service. And thank you so much for the support. That said, let's focus on the numbers then. The gross written premium and the net earned premium in FY25, that grew by close to around 4%. While the industry, I think, was growing in early double digits. What is the growth outlook on both these two parameters for your gross written premium as well as the net earned premium for FY26? If you could give us a sense.
Yeah, so basically last year growth was not up to the market. For the first half of the year, growth was pretty muted and we were lower than the industry growth rate. But in the second half, we picked up and I think we were with the industry growth. And in the last quarter, we exceeded the industry growth rate. So, I mean, it had a lot to do with, I joined New India in June. So almost for the first quarter, there was no leadership there. And after that, the growth was pretty muted in the first half. So I think somehow throughout the year, there has been a mixed bag. And for the industry itself, it has been a muted growth last year. Now, going into the future, we are very much prepared and to achieve at least a double-digit growth in the next fiscal. We have got our strategies in place and already targets are fixed across all lines of businesses. And we are well within our targets. April and the May growth rates are an indicator that we are well on our targets and we'll be achieving at least a double-digit growth rate if we go this way.
You want to give us a number? Double-digit, early teens, mid-teens, late teens? And will you outgrow the industry?
Early teens is what I feel is definitely possible. And my personal ambition is it should be somewhere in the mid-teens, if not better than that.
Got it. Let me get another number out of you. The combined ratios have come down sharply in quarter 4. I think it's come down to around 111 from around 119.
Yes.
For FY25, I think on an average, it was roughly around 117. What's the target for FY26?
Yeah, we want a downward trajectory for combined ratio for all the years now. And obviously, I would definitely want a much lower combined ratio. We are working very hard on our services, on our systems, on putting SOPs, on strict timelines and TATs for all our claim settlements. And with all these systemic improvements, I am sure that combined ratio will come down with increased emphasis on underwriting guidelines and more accountability at the employee level. And asking all our regional offices to be more focused on creating a profitable balance. I think all of this will result in definitely a downward trend in the combined ratio in the future also.
Ma'am, good morning. Again, here, is there any target set internally?
Target set internally has been always in the range of less than 110. I want a less than 110 combined ratio is what the target is, but the journey can be. It depends on various factors, both internal and external. So yes, if you ask us a personal ambition, it would be something less than 110%.
And of course, I mean, the journey is dependent on so many factors and you'll be able, I mean, in your opinion, you'll be able to get to it by when? Which quarter? By the end of the year? What's your sense?
On what?
The 110 number, the 110 target, combined ratio.
It would be a combination of increased our thrust on the retail lines. I think that would be one of the most important aspects. If you are able to achieve the retail expansion in a big way, which we have planned, if that happens, I think 110 would be more achievable on that score.
Your net earned premium, ma'am, grew just 4%. Total income grew just 1%. Despite that, the underwriting loss reduced by 31%. Operating profit grew about 1.35 times. Could you tell us what led to that?
No, actually, the underwriting losses came down heavily because of a lot of systemic improvements that we have done across all lines of business. And one of the reasons why it's come down is also selection of risk, which there has been an increased emphasis on selecting the right risk. So we have been refusing a lot of business also, which is doesn't make sense to us, is not viable. We have not written them. Therefore, the growth also is muted in a way. So I think these reasons have also added to the combined ratio coming down, the underwriting losses coming down heavily this year.
Okay, all right. Ma'am, I wanted your view on another topic. There were reports that suggested that the government is considering merging the 3 PSU general insurance companies into New India Assurance. Have you heard about the same?
No, these are rumors which we keep hearing. There is no definite proposal as such that I know of.
But
I really can't comment on.
But if it does come into play, wouldn't this be a big negative for New India Assurance? Because your solvency, your combined ratios as well would be under pressure, isn't it?
Actually, the other 3 companies are also turning around, and in the last year they have turned around, and they're doing much better than a year ago. So it depends on how much they turn around this year, whether they are able to come back into absolute profits, bring down their combined ratios. It's all a measure of that. It also depends on the timing when, if at all, there is a merger that is going to happen, and if at all it happens, then the timing of that merger is very important at what stage. Yes, the other aspects of whether this will pull down New India is something that everybody will surely deliberate on, and I'm sure without taking due caution, no such decision will be taken.
Is there any plan for OFS, ma'am? Any discussions on? The government would like to sell some stake?
No, as of now, there is no such instruction from BFS.
Okay. Just one more operational point. On the motor side, rates have not been revised for 4 years now. We put out a story saying that the government the industry has been making appeals for a while now. Is it likely to go through?
Yes, the indications that we keep getting from time to time are that yes, they're considering it and it will go through, and I hope it really goes through, because the motor TP as a line of business is getting increasingly unviable, and it's mandatory, so we cannot stop even doing it. We have to do it. So in the scenes, I am sure that we have to, the government has to step in and revise the rates to a stage where it becomes more sustainable.
And if it were,
it is long overdue.
And what would be the minimum required in terms of these rates going up? Because it's not happened for so long.
I think the workings have been given and they're quite extensive. They have been given to the government.
Okay. And the ballpark, what would you want is what my question is. I mean, of course, they'll have to decide.
Actually, see, now our combined ratio, our ICR for TP has gone up from 96 to 108, around 12%. And if you want to add some operational viability into it, and also the inflation and etc., then I think 15-20% is minimum that we would expect.
Okay, and as you're saying that, I really hope that it goes through.
That is wishing. If wishes were horses, then 15-20% would be minimum. Water tea.
Minimum. All right. No. Well, we'll see if it does indeed happen. But thank you so much for explaining all of that to us, our viewers. It's a real pleasure to have you with us this morning, ma'am. Appreciate it. Well, that's New India Assurance. Stocks up about 1/3%, 182. I think we can revisit trades back with a 9:10 call. Sudarshan is with us, and so is Chandan. And Sudarshan, what do you have?
Well, it's Astral. Buy Astral with a stop under 1397.
Okay. So that is Astral, which is Sudarshan's call, 1439 as of now. Maybe we can just quickly look at, because the pre-open has ended, just quickly look at the Nifty, which is up 50 points. So 24,996, and the two names I was talking about, Delivery, if you can just pull that up, how that is settled, and Protean, which at 901 was showing a sharply lower downtick. It should have settled now. It's down 13% this morning as well. So about another 150 rupee cut at the end of the pre-open session. 996 is where we're at. Let's talk about some of the stocks we discussed earlier. IRB Infra. Vivek is here to put the spotlight on this one. Vivek.
Well, that's right. Like we highlighted earlier, it's been a steady set as far as Q4 is concerned for IRB Infra. FY25, although, has been slightly muted given the fact that construction, tendering as well as construction both have been quite muted. Toll revenues and toll collections, though, have been quite strong, aided by price hiking across various toll collection booths. Now, talking about the Q4 revenues higher by a little over 4% on a year-on-year basis. EBITDA higher by 12.2%. EBITDA margins have expanded on a year-on-year basis, and profitability higher by 13.6%. It is important to note that the company now has changed the accounting policy, and now the company actually takes the gains that it receives from the private InvIT that it operates into the revenue from operations as well. So that will also be something that we can ask the management when they join us a little later. Now, when you're talking about the segmental revenues, BOT as well as TOT revenues have gone higher, 641 crore versus 619 crore on a year-on-year basis. The construction segment revenues, however, have dipped at around 1,200 crore versus a little over 1,400 crore. Now, when you're talking about the order book, remember the order book stands at a little over 30,500 crore, giving them enough visibility. But when you're talking about the segment-wise order book breakup, O&M portion at close to 28,100 crore. The EPC portion of the order book is quite subdued at 2,400 crore. So what is it that we need to watch out for? The bid pipeline as well as the tendering. And IRB, remember, with a couple of private equity investors within its balance sheet, it actually stands to gain with an upper ground, especially when it comes to tendering activity. The company yesterday in the press release said that as far as the bid pipeline is concerned, projects totaling a little over 870 kilometers valued at 45,600 crore is likely to be available for bidding on a BOT basis. So that's going to be key to watch out for. Tendering activity as well as competition when it comes to tendering. That is something that has ailed a lot of road developers.
All right. Okay, got that. Thank you very much, Vivek, for that. That's IRB in focus. Stocks actually doing well, along with NLC and Readington. These are some of the other result reactions that are holding out quite well. And of course, at 9:30, we'll have a conversation going with the IRB management as well. Interesting brokerage call coming in from UBS today on Hindustan Aeronautics. Now, UBS has downgraded HAL, but even after downgrading, their price target is 6,500, which I just checked is about 13% higher than where HAL is trading right now. So let's go across to RIA. Okay, I think we'll have RIA in just a bit. But I was looking at this call, since we're on the subject, let's pull up HAL. What UBS is saying is that the near-term drivers are priced, and that's really the question with stocks like HAL, right? They're saying that the resolution of the GE engines, that's a bit of a watch point. Then the LCA, fighter aircraft overhang could also weigh on the stock. But like I'm saying, their price target is 5,600. That's still about a 12-13% upside from where the stock is.
No, absolutely. We'll come to, and we look at some of these names. Yesterday, by the way, from the highs, they all corrected quite a bit. So we'll see how they start this morning. But we got first rates coming up, indices, and then we get to stocks. So what do we have? 24,995 on the Nifty, 55,500 on the Bank Nifty as well. So it's higher, nothing outrageous, but 0.25% on the Nifty and a little less than that on the Nifty Bank. Mid-cap index and the small-cap indices much better, 0.6%, 0.9% respectively. So this is a pretty decent start after the pause that we had yesterday. I think it should be all about broader stocks and broader markets because large caps I can't see very much, which is swinging around in a big way. Nifty heat map, I don't know if we have it. We'll pull it up and then we'll start talking about what's happening with stocks. There you go. I mean, I think about 9-10 stocks which are lower and everything else is up in the red. So it's a solid kind of start, at least at 9:15. Surabhi.
Okay, so let's talk about what's green. Nigel called it out. Metals all the way, thanks to the Chinese rate cut that's happened. Hindalco, Tata Steel, these are your top winners on the Nifty. 1.3%, 1%, 0.7%. These are the kind of gains. Even Coal India is seeing a bit of a rub-off effect. JSW Steel is managing about a 0.5% increase. So the metal space is shining bright this morning. Then you have some gains in the form of Sun Pharma, Infosys, Tech Mahindra, Dr. Reddy. So I can see pharma and IT, broadly speaking. Reddy's, Wipro, TCS, mild gain coming in. So there's a little bit of a green on these stocks. Banks are trying to find their momentum. The Bank Nifty, by the way, is just about 1% away from its 52-week high. So let's watch for this. SBI, ICICI Bank, Axis Bank, early movers, seeing some traction here. Let's pull up HDFC Bank as well. HDFC is still dragging. It's down about 0.25%. So let's see. On the downside, Power Grid, those numbers didn't go down too well, like Vivek explained to us. Bajaj Auto is cooling off after yesterday's big run-up. It was up 4% yesterday. Even Hero Motor, for that matter, all of auto is cooling off. M&M, Maruti, Hero, Eicher. So auto is seeing profit-taking. Then there is a stock like Titan, which is slightly lower. Shriram Finance, slightly lower. But there's no real trends. Clear trend, metals looking good. Little bit of buying in IT and pharma. And banks right now sitting on the fence. Nigel.
Well, let's look at some winners then. Readington, the EBITDA jumped up by close to around 30%. The revenues are up by close to around 18%. That stock is flying away. Remember, this is one of the underperformers actually of the last few years. But now it's come back. It's come back in style. I remember it being in that 150, 200 rupee range for a long time. And now, in fact, it's broken out. It's above 300 rupees. So big move is what we're seeing on that name. Karur Vaishya Bank as well. That stock should come up for you in the screen. The volumes are quite high out there. The numbers look pretty okay. So I think we should get that one up for you on the screen. CMS Info, we had the EBITDA number that was up by only around 4.5% or thereabouts. But you had margins that expanded to around 26.2%. The stock, though, a little under the weather. That's down close to around, I think, 1% or thereabouts. NLC India, the other stock that's actually flying away. EBITDA number coming higher by close to 43%. Margins coming in at around 22.5%. The street likes it. So that's why that stock is up close to 6%. A few losers. QuestCop, just pull up that one. It came out with its set of numbers. The street doesn't seem to have liked it too much. So the stock is down 8.5%. MobiKwik, that's the other one, in fact, that reported its set of numbers. The street has read it as a rather weak set of numbers. EBITDA losses continue. Revenues flat sequentially. So that explains why, that stock, in fact, is down close to around 5%. Pull up Bazaar, the engineering. Let's see what that one's doing. They've added, a supply contract for a period of around 5 years. And I think the market was quite positive about that. But the stock is up only around 1%. HFCL, they bagged an order worth around 170 crores. So that one, I think, had seen a good uptake to kickstart trade. HLE Glasscoat, now that one is coming up on the screen. Remember, it's been a big underperformer. I recall, the street had pinned its hopes on that one. But gradually, the stock was underperforming. But that's up in upper circuit. It's up close to around 20% as we speak. I think it came out with a set of numbers. And prima facie, it appears the street liked those set of numbers because big up move is what we're seeing out there. In the first minute itself, it's locked in upper circuit. Just looking at the numbers, couple of numbers, 330 crores is what they've delivered in terms of revenues. And the margins coming in at around 16%. After many, many quarters, we're seeing these high margins. So I guess that's the reason why the stock is up 20%.
Absolutely. And you mentioned Quest as well, which is a big loser. We had the management with us on the earnings. So it's a 30-point higher start now. So 24,975 is where we are at. By the way, just if you can quickly pull these names up, the defense pack is under it's profit booking. So Cochin is down 4.5, Garden Reach is down 4, Paras is down 5. So that's Cochin, Garden Reach, Paras, BDL is down 3, Idea Forge is down 3.5, HAL is down 2.5, Data Patterns is down 3, Mazgaon is down 2.5, Astra Micro, Midhani, I could go on. So it looks like, by the way, the only name which is higher is the management we spoke to yesterday, Zentech. Zentech has been doing 5% jumps every day. It's up 3 today. So 3.5% on Zentech. Otherwise, it's largely a little bit of profit booking that you've got going on. And I mentioned Protean eGov. in the pre-open. That is the fourth largest volume-led loser on the NSE. It's down 13% after yesterday's 20% cut. So stocks at about 990 odd rupees. There was of course, a conference call yesterday afternoon, mid-afternoon. We put out details out of that as well. Another name is DOMS, which is down about 5%. DOMS also reported numbers. So 2668 on DOMS. So that's one more name. The two sort of rockets yesterday, HEG and graphite. I can spot graphite with a small 2.5%, 3% kind of a cut. So that's
HEG also started lower.
HEG also slightly.
But we'll have the management of HEG actually later on in the day. How do they read this demand supply is going to be very, very important, because we know that supply will be a little bit short, but will it make a material difference? So I think in the next couple of hours, we'll have the management of HEG. So we should get some clarity. But yesterday, the stocks ran up. So I guess that's the reason why they're cooling off today. The adjusted numbers didn't look too bad, though.
Okay. Just two more trends I want to highlight. Railway, along with defense, a lot of railway stocks are cooling off. Last 2 days, there was some, action there. But today, your RailTel, RVNL, Aircon, IRFC, all these stocks are down. And the second is watch out for Restaurant Brands Asia. It seems the QSR space really has picked up. Pizzas, burgers. I mean, we saw good numbers from Jubilant after a long time as well. And that's a stock after numbers, 5% higher. The India business, I was looking at the numbers that Mangalam put out. The India business has done well, and margins have also improved. Same-store sales growth, finally, of about 5%, I think, for Restaurant Brands.
Absolutely. So, a long ignored space and people waiting on the sidelines for things to pick up. We'll see if this is the moment. But Pankaj Murarka is now joining us. He's CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Good to have you with us here on the program. Thanks very much. So tell us, Pankaj, what is on your radar? 5 themes or 5, even better stocks which are on your radar after the run-up we've had, which has been pretty powerful from off the lows. Things happen in double quick time. There's hardly any, you fall fast and you come back faster. So, it almost seems like did the fall actually happen in the first place? For many of these names, it appears like that. Your thoughts, and what are you focused on now?
Absolutely, Prashant. I absolutely agree with you. It's very difficult to keep pace with this market. So rather, I think for longer-term investors like us, it's more of the approach is more of avoid the short-term volatility and noise and focus slightly more on medium-term, long-term. The whole risk-off trade which happened in the world post the announcement of tariffs and then retreat by US in such a short period of time. And that has led to a risk on, and meaning life has come a full circle in that sense. I think one thing that clearly stands out in all of this volatility is India, I think, and there's a greater acknowledgement of that India is a Goldilocks economy, I would say. Because even during the peak of the tariff noise or risk, I think there's a clear acknowledgement of the fact that India probably will be the least impacted. Having said that, I think from an investment point of view, we need to concede that markets are fully priced. I think we eventually, India is the most expensive equity market in the world, and markets are fairly priced. Markets are already pricing in earnings over the next 12 or 18 months. So in that sense, obviously, there's no apparent value left on the table. I think, and from our point of view, my view is that returns from here on will be more in line with earnings growth. And we need to bear in mind that we're coming out of a cyclical slowdown in the economy. Last year, FY25, earnings growth at the index Nifty 50 level has been about 5%, probably the slowest earnings growth that we've seen in the last 5 years. Probably we'll see earnings uptick, but I still think it will be a modest, low double-digit earnings growth going into the next year. So for us, it's more about finding or identifying pockets where earnings growth can be somewhat higher than the aggregate index earnings growth. And as we've discussed in the past, I think 2 pockets where I see earnings growth surprising positively is one, banks, and within that private sector bank, the larger banks like HDFC Bank and Kotak Bank, which are coming out of a sharp earnings slowdown. And the second is the consumer as a sector, because I think consumer as a sector is coming out of a earnings slowdown of almost 3 years or 10, 12 quarters now. And we see all the signs of recovery in earnings growth coming back in consumption, probably both volume growth coming back, and that should drive superior earnings growth than what's already built into the street. estimates. Apart from this, I think another pocket probably I would say is IT, because the sector is still down about 10 to 12%. The large cap names are down between 10 to 15% from the peaks that we saw pre the announcement of tariffs. And it's apparent that things are not so bad in the US economy as it was perceived, now that there's a retreat on most of the tariff and all of that. So while the hangover might still remain in terms of what happens post the 90 days pause, but I think we should see an uptick in earnings recovery in IT as a sector in the second half of the year. So probably that looks a safe haven. I think those are the broad three sectors that will look like. And then I think after that, it's more about trying to find ideas on a bottom-up basis.
Sure.
One approach we
are Pankaj, let me come in over here. So basically, I'm glad you mentioned this. That was exactly my question. That relatively speaking, which pockets can see better earnings performance? You've named out three: private sector banks, IT, and consumer. Let me take up consumer because that's where market positioning perhaps is the weakest. So that's an area of interest for sure. We were just discussing this, some of the QSR names, the numbers have started looking good after a long time, after many disappointing quarters. So in consumer, what would you play? Till now, it was all about play consumption through a jewelry stock or play consumption through a real estate stock. But how would you look at it now for the next 12 months and beyond?
So we're trying to look at pockets where probably the growth can surprise on the upside. So as you rightly said, in the QSR space, we really like Jubilant Foods because we think there is just to give you a context, the total number of customers having in the organized pizza market in India, consuming pizza through organized chains is about 10 million in India. And we have, just to give you a context, there are about 50 million people trading in stock markets or investing in stock markets. So we think, the organized space can grow significantly. The room to grow in the organized space is very significant. And I think there is a strategy reset there in terms of the new approach that the management has taken, where they've made their offerings more value accretive to consumers. And for the last 3 quarters, if you see, they've been getting very strong volume growth, which effectively means they are raking in new consumers. So we're essentially looking for companies which, in an environment where growth really picks up, are doing something extraordinary in their business so as to deliver growth much higher than the industry growth. So in the QSR space, we own Jubilant Foods and we like them in terms of the strategies the management executing. Likewise, we own few companies on the durable side. So again, I think as we see, probably there are a fair bit of tailwinds at the macro level for consumer recovery. One, apart from in the low base, probably the tax cuts which are announced in the budget should start flowing into the pockets of the consumer during this year. And hopefully with good monsoons around, we should see a better second half spending environment for consumers. So that should help some of the durable companies. Within that space, we own companies like V-Guard and Crompton. And at the same time, after a gap of almost 5 years, I'm equally positive on staples companies because the volume growth for staples has been pretty low. So, but within that, we still like companies which are, taking strategic initiatives to accelerate their growth curve by getting into new categories or penetrating deeper into the existing categories so as to increase their market share. So some of the companies that we own in the space includes likes of Godrej Consumer and Tata Consumer, because these companies have been making significant efforts organically and also through acquisitions to expand their overall TAM, if I may say so, in the context of the new age companies, and accelerate their growth curve. And probably at least the stated management intent is to grow at 2x the industry growth, 1.5 to 2x the industry growth over the medium term to long term. And we clearly see management putting, taking strategic initiatives to drive that growth. So our bias is always to looking for companies which can deliver much higher growth and where management has taken strategic initiatives to drive that growth, because eventually that is what will translate into shareholder returns over medium term to long term. So yeah, these are some of the names that we like in the consumer space.
Okay, all right. Good conversation, good perspective there, Pankaj. But unfortunately, we're a little short on time because of earnings season. But really appreciate you giving us an insight on why you think that consumer is going to start reviving. Look forward to a longer conversation soon. Thank you for joining us this morning. Okay, that's a perspective from Renaissance Capital coming through. We move on now to our next company on the radar, and we're putting the spotlight now on IRB Infra. IRB is reacting favorably to the fourth quarter performance. Performance has been largely steady. Margins have expanded. The toll collections also look fairly strong for FY25. So let's discuss this and more with Mr. Anil Yadav, Director, Investor Relations at IRB Infra. Mr. Yadav, thank you very much for joining in. So the toll collections have been strong, but when I look at the overall growth for the company, whether it's fourth quarter or the full year, it's in low single digits. I mean, fourth quarter about 4%, full year revenue up about 2.7%. So let's start with the toll revenues and what you're penciling in here in terms of traffic growth, any increase in toll charges across the major assets that you operate. Give us a sense on the tolling business, then we'll talk about the others.
Yeah. Thank you. Thanks for the opportunity. In terms of toll collection, as we have highlighted that this financial year overall growth on IRB and private InvIT put together, the growth was 23%. And we command 10% of the market share as far as overall India's toll collection is concerned. Overall, India's growth in terms of toll collection was 12.5%, whereas IRB's growth was around 23%. And we have started a couple of projects in the FY25, that was TOT 12 and 13. There, the numbers were much better than our expectation. In fact, we have surpassed our initial estimate on both the projects. And in terms of we have already declared the April month's number. There also we have seen a healthy traffic growth and also tariff revision from the 1st of April. And we have a couple of projects, that is one Palsit Dhankuni, where it's a 4 to 6 laning where we are collecting toll at 75%. Once the project is about to complete, then we will start charging 100% of the tariff. And plus there will be 3% escalation also there. So that will further improve the toll collection. And Ganga project is also on verge of completion. We expect project to operational from second half of this financial year.
So would that mean that you continue to grow your toll revenues at 20%, 25% this year? What's the outlook?
Yeah, I think this financial year, we have not added any asset. Last year, the growth was 23% on backdrop of the Hyderabad ORR project for FY24 was operational for partial half of the year. And 2 projects we have added the last financial year. This year, April, we have delivered a 10% growth. And we expect low double-digit kind of growth in the toll business as only 2 projects will become operational, which will be from the second of this financial year.
Got it.
But if we will get the further asset, then definitely the...
Fair enough. No, that makes it clear. 23% was because you added big assets like the Hyderabad one. This year, as of now, you're looking at low double-digit growth in your toll revenues. Got that. Now, I want to come to the construction business where the revenue had a small dip. I think you're at about 1,200 crores. Now, that's a large part of your business, but it doesn't seem to be picking up enough steam. Maybe it's lumpy in nature. But what can you guide on the construction side?
I think construction business complement our asset business. We have an asset base of 80,000 crores. We do construction for in-house private InvIT, public InvIT, and subsidiaries of IRB. And going forward, also our focus will be more on the asset business. And if one looks at the EBITDA, also around 65-70% EBITDA comes from the BOT business, and gradually it will. The construction business, since there was low activity in terms of new award, construction revenue has declined, but which only contributes 15% of the overall business. And going forward, if you look at in last 2 to 3 years, our O&M revenue is consistently increasing, and where we have visibility of around 20 years in terms of the O&M revenue, and we have good margin on the O&M side.
Just a clarification now in terms of revenue recognition. Our research team is just asking for this clarification. You're adding toll collections. With the new accounting changes, the toll collections are treated as revenue, right?
Yes. So in terms of if you look at the accounting for the company, toll collection is treated as revenue for the company. And this was the consistent accounting which we are following from our listing days, that is in 2008. Construction revenue based on the IFRIC 12 principle initially, and now there is a accounting standard also that also gets accounted as a realized revenue, and construction revenue also forms part of the revenue.
Okay. So let's talk about the tendering pipeline and some visibility on what the construction part of your business is going to look like. The toll part you've already told us, low double-digit growth. So it'll keep growing steady. But what about the rest of it? And my question is really, I mean, on a top-line basis, like I said, this year, it's been very flat, just 3% top-line growth. What will FY26 look like?
I think in FY26, as we have seen a very slow award in terms of the project, but pipeline looks quite robust. If you look at last 1 decade, the large capex in the road sector was funded by the government. And now the monetization of those projects will happen. So those projects will expected to come on TOT basis. And government is also talking about private participation. We are expecting roughly 60,000 crores worth of project on a TOT basis, and around 45 to 46,000 crores worth of project is on a BOT basis. And as and when those projects will up for the bidding, we will be participating for those projects. But with respect to the existing business, I can assure our investor that our bottom line can, with the consistent increase in the toll revenue of 10-12%, our bottom line can grow also in that range.
Okay. So, then that's low double-digit growth in the bottom line as well. Margins have looked good. Margins have been consistently improving. At the EBITDA line, you're almost at, I think, 46.5%. So does this remain intact? And this opportunity that you mentioned, the TOT opportunity, those are large numbers. I mean, how much are you confident of getting? Any sense of, how your order book is going to look like, total order book?
Yeah. In terms of first in terms of TOT requires upfront capital. And if you look at the company, we have cash also on the books, and our debt equity is net debt to equity is 0.59:1, which is lowest as far as industry is concerned. And plus, the private InvIT has offered 3 assets to the public InvIT, where the EV is around 8,500 crores and equity expected to realize is 4,800 to 5,000 crores. With a 5,000 crores of equity realization, typically the TOT projects are funded 65 to 35 or 70-30 debt equity. If you consider 30% or 35% equity, we can add around 15,000 crores with this kind of asset sale, what we are doing from the private InvIT. So we have sufficient liquidity available to bid for the project. We have our asset base as of now is 80,000 crores, and we have aimed to reach to 140,000 crores asset base in next 3 years.
All right. Thank you very much for that explanation, pretty comprehensive in all respects. Thank you for joining us, and good luck as we look ahead. Well, I think the market is not doing very much. It's a very quiet Tuesday morning. It's about 14-15 points in the green. There's the advanced decline is almost 1:1, about 1,200 up and about 1,230 lower. So not very much happening directionally. And, the one big thrust area for the last 2 weeks, which really was keeping the, lights on in the broader market, was the entire defense pack, because you had these big, massive moves showing up. And there are lots of listed names now. There is a little bit of a pullback which is happening there. It's not as if there aren't stocks, but more limited.
Prashant, just want to highlight a few. Equals India Mobility, I think that's the new listing. That's up close to 13%. So big up move is what we're seeing out there. Pfizer is up more than 10%, and volumes are quite large for a counter like Pfizer. And Restaurant Brands Asia as well, Mangalam told us earlier, that stock as well has spiked up. So there are select stocks that are moving very, very well from the broader markets on rather large volumes.
Absolutely. And we'll, Pfizer especially is interesting. We'll come back to that in just a bit. But Hyundai reported numbers, inline performance in the fourth quarter, supporting realization came through. Company aims to launch a 526 new car by 2030 and is expecting 7 to 8% export growth this financial year. My colleague Parishit caught up with Tarun Garg, whole-time director and COO at Hyundai Motor. began by asking him about the quarter gone by and how they see growth going ahead.
It was a very satisfying quarter. You saw the results coming in. As you know, Hyundai India, we believe in volume, market share, and profitability all put together, having a balanced growth approach, especially focusing on the quality of growth. So if you see the EBITDA margin for quarter 4 was at 14.1%, which helped us to have a yearly EBITDA margin of 12.9%. Return on capital employed was very healthy at more than 40%. The PAT, all the numbers look quite good. So we are very encouraged, both by the market response as well as the overall numbers for quarter 4. Going ahead in financial year 24-25 and 25-26, we can see that there are some headwinds, of course, but like every 5 years in the industry, we see a year where we see some muted growth. So we have to see how to navigate in these situation of macroeconomic as well as geopolitical challenges going forward.
Right. Now, you spoke about muted growth. This has been a concern for Hyundai and other companies as well. How are you navigating this, and how will you diversify your product mix, also your export strategy to deliver your growth targets?
Absolutely. So look, first of all, we are not really very worried about it because I have been in the industry now for 31 years and I have seen those ups and downs. In fact, if you see the last 20 years, after every 4-5 years of sustained growth, 1 year of a muted growth has always come in. Here also post-COVID, we saw some huge growth, more than 20%, more than 10%. CAGR though has been hovering around 4.5-5%. So we have seen that because of the geopolitical situation, Indo-Pak tensions, of course, the uncertainty around the tariffs. I think one thing which a car customer does not like is the uncertainty. And I think that has really affected some kind of a IT slowdown, of course. The interest rates have been high. But when we see the positives, I think now we have seen the repo rates coming down. We see that the tariff uncertainty is also kind of probably becoming more clearer on the positive side. We have seen the stock market rebounding, over the last month or so. So I think things are looking good going forward. And as far as Hyundai is concerned, we believe very strongly in the growth story of India. And you would have seen our very, very aggressive launch plan of 26, launches in the next 5 years until financial year 30, which includes 20 IC cars and 6 EV models. So we are pretty confident. Our new plant is coming up in the quarter 3 of financial 25-26, which will not only give us more, space for both domestic and exports, but also, with the new plant, the new model cycle will kick in. So I think there are more positives, looking forward, both for the industry as well as Hyundai.
What I would also like to ask you is about the sentiment going forward. How does quarter 1 of FY26 look to you currently when you compare the sentiment and performance in quarter 4?
So look, India is a very seasonality-driven market. We all know that, like for example, if we see the financial year, H2 of a financial year is always much more retail-driven with the festivals coming in. So October to March is generally a very high retail period, whereas April to September is probably a muted period because of the no festivals, because of also the heat waves in the northern part of the country. So, but this is very normal. So I think there is nothing to be very perturbed about. Things are improving, like I said, both in terms of the stock market sentiments, in terms of geopolitical, in terms of macroeconomic. So I think we have more reasons to be positive, especially on a Hyundai front, where in the quarter 3 with our new plant coming in and the new model cycle kicking in, I think we are more optimistic than ever.
Right. What will be the initial capacity of production at Talegaon, which comes into effect from quarter 3 of FY26?
So we will have the capacity of 170,000. So currently we have the capacity at the Chennai of 824,000. So this will take us to 994,000. And I think one very big thing which is going to change is a big thrust on exports. Of course, right from the time we set foot in India, exports has been a very important part of our strategy. Currently, exports are contributing about 21% of our total volume. Going forward by 2030, we believe the potential is to reach about 30%. So we are really looking at not only in terms of the new products which are going to come in the IC space, but also in the EV space as well. So we are currently catering to the developing markets, emerging markets, Middle East, Africa, Latin America, Asia, of course, and of course, like I said, with the EVs kicking in and more models, especially in the SUV space, I think opportunities only keep on increasing. For example, last year, we launched the Exter in South Africa. Next year, we are going to launch the left-hand drive of the Exter, which will improve, which will add on many more markets, especially in the Latin American market for us. So I think we are very, very determined that to really leverage this export opportunity which is coming to us.
What do these FTAs? India has signed an FTA with the UK. They are on the verge of signing FTAs with European Union and United States as well. What could this mean in terms of using India as a manufacturing hub for other global markets in Europe, in US and UK for that matter?
Look, like I said, the advantage HMI holds is that we are a part of a very strong group, and Hyundai Motor Group has presence all across the world. We are doing so well in US, we are doing so well in Europe. And of course, India is the hub for the emerging markets. But going forward, I think these are very interesting. Probably, not only Europe, but maybe, there will be opportunities in the Southern Hemisphere, maybe Australia going forward as well. So it is very difficult to really comment right now because the contours are still being finalized. But I think we are really looking at these FTAs with a lot of excitement and interest. And we will see what new opportunities can come in, especially when more and more EVs come in. You have seen in our plan that out of those 26 models, 6 are going to be EVs. So I think that will really open up more space for us in addition to the current markets which we cater to.
My final question, sir, would be about how do you plan to use the CapEx outlay? You've got a 7,000 crore FY26 CapEx outlay. How will this be spent for capacity expansion, for manufacturing, and also for product development?
Like I said, look, the exact guidance on the CapEx we will be sharing during the Investor Day. On a broad basis, about 60 to 65% is towards the capacity expansion in Pune, as well as for the new models. You have seen our very aggressive new model plan. I think this is very good, very good. Our track record on return on capital employed is extremely good. Even in financial year 24-25, it was more than 40%. So I think this is very good news for us. And we are generating cash, which means that we have been able to utilize our internal resources for this CapEx. But further guidance will be given during the Investor Day in September.
All right, the markets actually are now down close to around 50 points as we speak. The Nifty Bank, well, that's down close to around 250 points, closer to around the 20-day MA, which is at around the 55,000 odd mark. I'll tell you what, we'll slip into a short break. You come back, we'll get chatting with the management of Arvind Fashions. Stay with us. Welcome back. Well, this is Corporate Radar, and as promised, let's get to our next corporate, Arvind Fashions. Well, the Q4 revenue growth has remained steady. Margins have improved a little bit, though there was a loss of around 90 crores or thereabouts. Mr. Kulin Lalbhai, the Vice Chairman at Arvind Fashions, joins us on the show. Hi, Kulin. Good morning. Good to see you. And as always, well, the high single-digit momentum continues even in Q4. But how are the trends? How is demand on ground? Couple of months, we're already into the new fiscal. For the year, can we see double-digit revenue growth? And also in the past, you've been speaking about this 100 basis point improvement in margins. It holds true even for FY26. Margins will be 100 basis points better than FY25?
Yes, FY25 was a very good year for us. We accelerated our growth significantly. We doubled the growth of the company. And I think we've got very exciting growth levers ahead of us. I think we are accelerating our square footage addition. Our adjacent categories doing very well. We have clocked 5% like-for-like growth annually, which shows that the core franchise itself is very healthy. We have been increasing our marketing investment. So we are seeing higher demand for our brand. So I think in all, we are quite excited with the trajectory, and we do expect a further acceleration in our growth rate as a company. We want to get into the double-digit growth rate, as you mentioned, and we hope to achieve that in FY26. As far as the bottom line is concerned, FY25 was again a very good year for us. We grew our PAT by 70%. The Q4 loss that you talked about was just an accounting one-time write-off due to a DTA, where we moved from a tax rate of 35% to 25%. But if we take away that accounting adjustment, our bottom line has gone up very, very well last year. We've had 100 basis points improvement in EBITDA, and we hope to continue that similar trajectory. Last 3 years, we've been doing 100 basis points improvement every year, and we intend to continue that momentum.
So, Kulin, hi, good morning. What is the guidance then for FY26? What should we expect?
Yeah, so we are expecting, the demand situation to keep gradually improving. I think the announcements of the budget and the cuts in interest rate will start showing up more significantly as the year progresses. But as I mentioned, we ended last year at around an 8.5% growth rate, and we expect that to accelerate into the early double digits this year.
Okay, early double digits this year. Or just since we're talking numbers, let's get the margin bit out of the way, and then we can dive into operationally what's happening. Would you want to guide us with that profitability?
Yeah, so our guidance has been around 100 basis points. We've been investing heavily in marketing. So last year we invested almost 40 basis points more in marketing. We intend to do that again next year. But even after that, we hope to get close to 100 basis points improvement in the margins as well.
Okay, all right. Kulin, the adjacent categories, footwear, kids' clothing, innerwear, I think they contribute ballpark close to around 20%, right, of your mix. Could you tell us what is the profitability of these segments? And also you could tell us, as a percentage of the pie, what does it increase to?
Yeah, so it's around 20%, as you mentioned. And if we take the whole basket, the profitability is almost identical to our apparel franchise. So this is not, margin dilutive in any way. The growth rates are much higher than the core franchise. So we grow this business at close to 20% as a basket. So over time, its share in our total revenues will slowly inch up.
Okay, and on the footwear side, I remember exactly a year ago, you'd given some numbers on footwear in terms of where you'd like to be. Would you like to update that, especially for footwear? What's the size of the business that you can do in at 26 beyond? Just some sense.
Yeah, so we are now going to be larger than a 300 crore business. It had slowed down a bit in the last 15 months because of BIS challenges. Now those are behind us. So the supply shock that we had has receded, and we'll have full supplies as we exit this quarter. So we are very bullish that growth will move back to 20% plus levels in the footwear franchise. So we are aiming to become a 500 crore footwear business very soon.
Just one point, this early double-digit growth that you said for FY26, is that contingent on underlying demand recovery as well, or that will be an extra push if it comes through? Because, it's not new, but you kind of constantly hear that flush over the last couple of years, which led to a lot of spending, retail consumption, etc., that is starting to peter out. Maybe these tax cuts, etc., will help, but who knows? So I just wanted to get a sense, is that if it comes through the underlying demand, the consumer is starting to feel better and starting to spend again, will that be extra, or is that baked in what you told us?
So we are assuming reasonably muted demand conditions. So when we have built our growth plan for the year, we have not assumed a very large change in consumer sentiment. But of course, the range could change by 1-2% depending on the market conditions. But we do hope that even in challenging conditions, we will grow more than we did last year.
Any of your brands you're particularly sort of bullish about? Anything at an inflection point? We've spoken in the past about brands like US Polo, etc.
I think different parts of the portfolio are seeing different kinds of excitement. So US Polo has crossed the 2,000 crore mark, which was always an important milestone for us. And we've invested very heavily in that brand. So we've got a great brand ambassador, Padmanabh Singh Ji from Jaipur. He's our brand ambassador, very brand relevant, as he's also all about the game of polo. And we've been investing very, very heavily in making the brand young and exciting. Our new formats are much larger formats with a full lifestyle presentation. Very attractive like-for-like growth happening in that brand. So I think that's a breakout brand for us. Tommy CK have amongst the highest profitability profiles in the market, and they dominate the price point, and they continue to go from strength to strength. And even Aero and Flying Machine, where we've been carrying out a turnaround, are showing a lot of promise, and the base there is small. So on that base, there is a lot of potential they have as well. So I think across our 5 brands, we're very excited with the current platform and where we can take these brands.
Okay. All right. Kulon, we'll leave it there. Thank you very much for joining us, and we wish the consumer does feel better, and underlying recovery also comes back in addition with what you're building in terms of your own steam. That's Arvind Fashions with the perspective on the business. Early double-digit growth for FY26, 100 basis point improvement in profitability. Those are some guidance numbers. Markets, by the way, taken a bit of a dip. We're down 60 points. We were down 65, 70 just a while back. So market breadth has also turned a little bit. 1,500 stocks are down and about 990 stocks are higher at this point. So nothing major, but you are slightly on the lower side at this point with lots of stuff which is seeing pullbacks. Largely, you had to account for these as profit booking because run-ups have been pretty sharp as well. Sony Patnaik of JM Financial Services is with us with just a quick word on the market itself. Sony, good to have you here. What do you make of it? Are we in for a bit of a consolidatory phase, pause? We saw yesterday was that. What's your sense?
Hi, good morning, Prashant. Thank you for having me on the show. Yes, I think what Nifty's option chain is reflecting is a bit of a resistance around the 25,000, 25,050 odd range, because call writers are clearly dominating that level. A lot of writers can have positioned themselves around those levels with more than 2.5 lakh contracts that can be seen. So as long as that resistance of 25,050 is not taken out, further upside may be difficult for current expiry. Also, what we can see is a bit of a consolidation between 24,750 to 25,000 range. So I think this 300, 350 points could play out for the next 2 to 3 days. Similarly, for Bank Nifty, we can see that there's a bit of a resistance around the 55,500 odd levels. However, Bank Nifty also has a very strong support around 55,000. So if it breaks 55,000, profit booking may intensify for another 400, 500 points. But until then, it may play out in the range of 500, 600 points.
Okay. All right. What about individual stocks, Sony? What are you tracking?
Sure. Good morning, Nigel. So the first stock would be a buy in Coal India, which has clearly given a good breakout above its 200-day EMA hurdle. So one can buy Coal India in futures at current levels around 411 to 410. So that range could be the buying zone, keeping a stop loss of 405 and a good target towards 425 to 428 levels can be seen. It has also given a very strong option chain breakout above a 410 mark as of today. The second buy is a conditional buy from the from the financial space, that is HDFC AMC. The condition is that if HDFC AMC is able to give a breakout above a 4830 level in futures, it gives a good option chain breakout. So one can buy in HDFC AMC futures above 4830 for targets of 4950 by keeping a stop loss of 4790.
Okay, all right. Thanks a lot for that, Sony. Well, let's focus on a couple of stocks that are moving around. Readington, the stock started gap up. I think it's taken some kind of profit taken from the top, but the numbers look quite good. Vinny joins us to give us a quick analysis. Vinny?
Hi, so yes, it's a good set of numbers that's come in from the company. Sequentially, when you look at it, the revenue seems like a muted growth, but on a year-on-year basis, a strong growth of 18% is what we are seeing, and the revenues for the year, quarter-ended Q4 FY25 are coming at around 26,400 crores. Now, in terms of the margins of the company, they are largely at that 2% mark, where whether you look at it sequentially or even on a year-on-year basis. So 2.3% is what the margins have come in this time, and not an increase but not a decrease. So stable margins is something that is also a positive sign there. Profits of the company, a sharp growth on that front as well, whether you look at it sequentially, 66% growth, year-on-year basis also more than 100% growth, and that is what is keeping the stock abuzz as well. Overall good performance coming in from the company.
Okay, all right. Thanks a lot for that, Benny. Well, let's go across to Mangalam. He's here to tell us about restaurant brands. That's the other set of numbers that actually look quite good. Mangalam, what are you up to?
Well, eating a lot of burgers, for sure, Nigel. I tell you what,
But Mangalam, it's not fair. You said pizzas were good, burgers numbers are good. Nothing's coming in my plate, bro.
Soon, Nigel. I tell you what. I was just looking at their numbers, Restaurant Brands Asia. If you look at the overall consolidated numbers, they wouldn't ring much a bell because it's a 5.9% growth in their revenue. The EBITDA is also up 5.8%. So no major change in the margins. Net loss is narrowed, but that's because of higher other income and the fact that there is a big depreciation component as well. But this is India plus Indonesia. Indonesia has been under pressure for them as well. Important part is India. Is it showing signs of recovery? Oh, yes, it is. 11.5% revenue growth is what we've seen in their India business. The EBITDA has actually jumped by 16%. Average daily sales have increased by about 5% as well. And if you look at their same-store sales growth at 5.1%, it has far outpaced, McDonald's same-store sales growth at 0.7%. So all of these factors working in for Restaurant Brands Asia, the one that runs Burger King operations in India. They've added 3 stores during the quarter, but they have a target of 80 to 90 stores every year for the next few years, reaching 800 stores by FY28. So those factors is keeping the stock abuzz. But just on a side note, their product as well, some of their products that they've recently launched are rather tasty. I've tried them.
Care to detail which one?
It's the Korean range. It's fairly spicy, good. And I think I had the paneer one, Prashant. The chicken one you would enjoy a lot more.
Okay.
All right, thanks for that. Okay, right. I think we've got some flashes at the bottom of the screen. Seems important. CNBC-TV18 has accessed Form 483 issued for Aurobindo's Durham facility. And we will have more details on this one with Ekta in just.
The facility basically was inspected between the 24th of March and the 10th of April 2025. And there are 11 observations that have been issued. And some of those observations should come up for you on the screen. So this appears to be the big news point. I think Ekta will join in to give us further details. But failure to thoroughly review any unexplained discrepancy, that's something that's one of the points that is mentioned out there. Equipment and utensils are not clean, maintained, and sanitized at appropriate intervals. I think we'll have to find out what exactly is the contribution out there. But for the time being, the stock was, I think, higher. Now, in fact, it's cooling off a little bit. And lab controls do not include establishment of scientifically sound and appropriate test procedures, Prashant. So I think,
So this is a plant, Nigel, this is in the US. It's in North Carolina. And I think this is, I think this is the facility. It's a R&D pilot plant. It's all from the Aurobindo website. But Ekta will join us. Typically, what you're looking for in terms of details, when you look at details of a Form 483, is whether these are, procedural issues or are there any sort of integrity issues as well, which are more serious to resolve. If it's the latter, it's more serious. If it is sort of, straight cut, GMP type of violations, which are detailed, those are easier to resolve. So we'll be able to make that differentiation with Ekta in just a bit from now. But stocks up about 0.4%. There's not very much move right now. We'll come back on this story in a bit. Let's talk about NLC India. Stocks up about 4-5%. Vivek is here with details on this one. Vivek, morning.
Well, good morning. Like we highlighted a little earlier on NLC India, when you're talking about FY25, remember, a couple of very important projects came on stream in this particular, the Katampur second unit got commissioned. So all of that has actually aided as far as the power unit is concerned. But when you're looking at the numbers themselves, revenues on a year-on-year basis, higher by 8.4%. Mining revenues, although they were down 8.3%, it was more than offset by the power generation revenues, which was up almost 10% on a year-on-year basis. The core EBITDA, given the fact that there have been significant movements as far as the underlying items are concerned, core EBITDA has gone up by almost 43%. Employee expenses, surprisingly, has been very high this particular quarter at almost 1,090 crore versus just around 700 crore on a year-on-year basis. EBITDA margins thereby have gone up by almost 550 basis points, and profitability, multiple one-offs over there, has jumped up almost 4.2 times on a year-on-year basis. Now, when you're talking about the FY25 performance, what the street may find a little muted is the fact that the lignite production was up only 1.6%. However, the coal production actually saw significant uptick, lower part of the of the overall pie, but it was up almost 36% on a year-on-year basis. Power generation steady, up 2.8%. Overall, a steady set of numbers, a good set of numbers as far as the FY25 is concerned. All eyes now will be on value unlocking as far as the green part of the renewable energy part of the unit is concerned, and that is something that the street will look forward to in terms of timeline.
Okay, all right. Thanks a lot for that, Vivek. For the time being, we slip into a short break, but metals, they are in focus. Manisha Gupta will join us on the other side to tell us what's going on in the commodity space.
Welcome back. Well, the market, of course, has taken a bit of a dip from being up. We're down about 45 points, but nothing major at all, as I've been saying, 24,900. Let's focus on commodities then, what's happening in that part of the markets. Manisha is here, as always, to tell us. Manisha, morning.
Morning, and thank you for that, Prashant. It's the metals that I'm keeping an eye on, and we haven't seen good gains or positivity come on in last week or 10 days there. Well, actually, when you look at metals like aluminum and zinc, they're trading in the negative for 2025. Aluminum in Asian markets right now has extended declines further. It is down by 4.5% for the year now. Remember, the aluminum prices did go to 9-month highs in the month of Feb. That is when the US had announced 25% of tariffs. But since then, we've seen a steady decline coming in for the prices there. The reason is a surge in available stocks on LME there. We have seen very big gain onto that one. And 343,000 tons of LME aluminum stocks are at this point in time. Also, when you look at the speculative positions when it comes to aluminum, the net shorts are the highest since July 2024, and we also have seen winding up of long positions for aluminum. So not too many money managers believing that the aluminum prices can go higher from here, at least in the near term there. And then you're dealing with a very weak Chinese data as well. All the numbers that we've seen in last 24 hours, whether it's a factory activity, retail, sales or fixed income investment, all of those numbers have come in lesser than what the street was anticipating. If you look at the overall global demand, well, that also has been revised to a lower side to just about 1% on an year-on-year basis. Estimated surplus for this year in sense of aluminum is counted at around 200,000 tons. So everywhere that you look, whether it's about mining, position holding, inventories or demand, does seem on the weaker side. Also remember that the auto sector consumes nearly 25% of global aluminum demand, and auto sector also has been on a weaker side in various countries, and that continues to weigh in as well. And then it's about China, where we are looking at the major production and consumption. Here as well, the Jan to April output gained up by 4%, and 14.8 million tons is what we are looking at. Anyways, when you look at Chinese aluminum production for 2024, that was a record 45 million tons. And for this year as well, so even as China is not producing so much aluminum in the country, but offshore and overseas capacities have been increasing. Alumina shortage, which we saw last couple of years, also seems to be easing. So you are looking at higher refining, higher production, higher mining as well. All of those factors continue to weigh in case of aluminum. When you talk about the outlook going forward, well, that's quite a mixed view, really. JP Morgan has come out with the latest report suggesting that you could be looking at prices going down from here. So currently, aluminum is trading at $2,500 a ton, which could go down to $2,200. Goldman Sachs talks about $2,000 here. Bank of America is yet to change their report, but what came in the earlier part of this year was $2,800, and aluminum prices currently are far away from that.
Right, Manisha, thank you very much for that. That's a commodities update, as always. What we're going to do is take a quick commercial break here. On the other side, it's our special segment, Indianomics. Latha in conversation with Kaushik Das of Deutsche Bank, Arudeep Nandi of Nomura Financial Advisory, Anubhuti Sahai of Standard Chartered Bank to discuss what to expect from the fourth quarter GDP numbers. Stay tuned.